Hello, this is Derek Iswell, Chief Investment Officer for Shelton Capital Management with the CIO Minute. This week, the European Central Bank raised rates from 50 to 125 basis points, following their first rate hike back in July. With the Fed already at 250 basis points with more on the way, the question is the ECB behind the curve? Well, maybe. The difference is that Europe's inflation issues are more closely tied to energy and not as much to excess demand and supply chain issues. This chart shows the inflation rates and core inflation rates, that is, without food and energy included, across the US and Eurozone. And while only a bit more than a quarter of the US inflation can be attributed to energy, fully half is energy related in Europe. Looking at gas prices specifically in this chart, you can see that gas prices in the US are about $8 to $9 per million BTUs, which is actually fairly high for the US. While in Europe, they're 6 times that at close to $60 and actually touched $100 per million BTU just a few weeks ago. Europe has to walk carefully here. The central bank can only affect demand, and at the same time, they'd like to keep rates low enough to allow investment in the necessary energy infrastructure to relieve their dependence on Russian energy and assert greater energy sovereignty for themselves, such that they can avoid these energy crises in the future. And so for now, lower rates will help that in the long term. But in the short term, what they really have to hope for is a mild winter. Thanks for checking in, and this has been another Shelton CIO Minute.